Good morning, guys. Welcome to the show. Listen, glad to have you guys here. Let's get started. The first thing I want to talk about is China. Let's get started and let's open up the charts right here and let's take a look at what's going on. You know, the world has never, ever seen anything like this before. Really, never. This is a real estate bubble that has never been seen before and will never be seen again. You think the mortgage crisis back in 2008 with the real estate crisis in the United States was bad? It would be this big compared to what's going on in China right now, which would be like this. If it was an orange, what happened in the United States back in 2008 with the real estate crisis, with the malinvestments. If it was an orange, this is a watermelon. Okay? That's the difference in size. And China's huge number of vacant apartments is starting to cause a problem, but it's more than a problem. It's over the top. China has a well-documented problem with ghost cities across the country. Third and fourth tier cities are built on the spheres of crowded metropolises like Shanghai and Beijing, with the promise of becoming economic hubs in their own right. In other words, they're looking into the future. They've sold all these houses to these people, telling them that these third and fourth tier cities are going to be built up to be like Shanghai and Beijing. So people have bought in advance as investments. And what they have is they have shells of cities. And now what's happening is China is starting to go into decline, because China was consumer-based, based on others as being the consumers. And they've sold products to these countries who are consumer countries. Now, China is trying to make a change over to being a consumer country themselves. But the problem with this is their money has all come from selling products to consumer countries. And so they've inflated their economy with all of this selling, but now they want to become consumers themselves. And where are they going to get the money to become consumers themselves if they've invested all their money in an inflated housing market that's getting ready to burst? It says this inflated housing market has created a bubble that could soon burst. Well, I think it's going to burst very soon. It says these unsold properties are not only the problem. It says there are tens of millions of units that have been bought, often by entrepreneurs and speculators who have no intention of living in them or renting them. Some are bought as vacation homes for single family members. It's traditional for grooms to give their brides an apartment, but in many cases, buyers hold them as investment properties with the hope of eventually selling them for profit. These vacant units make up more than 1/5 of China's entire urban housing stock. And they call them ghost cities. That adds up to more than 65 million homes sitting empty nationwide. Now, 65 million homes. Compare that to what happened in 2008 with the United States housing crisis. You know, 65 million homes sitting nationwide empty in China. It says, and they aren't all in the ghost cities. In fact, the survey found an issue that the most severe is in second and third tier cities. And it also includes first-tier cities like Beijing and Shanghai. In other words, this homes are sitting empty. Nobody's in them. Now, what happens to an empty home when you leave it sit year after year after year empty? Well, animals invade the home, for one thing. They tear the home to pieces. They rip holes in the walls. Pipes start to leak. And because there's nobody even in there to check the place, there could be water stains all over the floor. There could be mold growing. There could be plaster and drywall falling on the floor. Are you starting to get the picture of what these, and these are homes that are supposed to be valued at millions of dollars, apartment units and stuff, and the place is just like a total shambles. Unconnected wires, appliances that don't work. Nobody's living in them, and nobody will live in them. And what do you think in the end is going to happen to this surplus of real estate in China? It's going to collapse in price. And this is where most of the Chinese have invested their money, because it says right here, China is got restrictions limiting overseas investments. And this has been a driver that's led to these housing investments. So we got huge problems there. Now, let's get over here and let's talk about what's going on. It looks like, to me, like a lot of people are saying silver's been smashed down. I don't think silver's been smashed down. Here's the silver chart right here today. It's down again today, and it's riding at 1512. Now, this is hugely down. I think this is the effects of what the Fed's been doing with their quantitative tightening, and they're raising interest rates. This sort of environment, you know, we did have a little bit of a pop in the gold and silver price, but that was on the enthusiasm, on the word from the Fed, when the Fed said, hey, you know what? We're going to end the quantitative tightening and we're not going to raise interest rates. We're going to be, they used the word patient. They didn't say they weren't going to. They led the market to believe that they were not going to by using the word patient. But the real truth of the matter is the Fed has done nothing. They are still tightening. They're still in tightening mode. And so we're starting to feel the effects of that tightening mode. And the first ones, the canary in the coal mine, is feeling the effect is gold and silver. And look at the price today. Let's take a look at gold. 1286. It's dropped down below 1300. 1286, down $6 today. Now, Bitcoin is feeling the effects of this too. We're looking at a dropping price of Bitcoin today. Bitcoin's at 36. You notice how Bitcoin and gold are starting to move together? Interesting, isn't it? Bitcoin 36.95. You know, it's dropped because it was up around $4,000 not long ago. And now it's dropped down to 36.95 today, and we got a falling Bitcoin price. Let's take a look at coin market capitalizations today. We're looking at 125 billion. We've lost, the industry has lost $5 billion in the past just day or two. It's lost $5 billion, 52.6 billion. If we take a look at these coins, we see descending prices. This is the effects of what the Fed's doing. They haven't changed monetary policy yet. What's going to feel the effects next? Well, my guess is it could be the market. Okay, could feel the effects next. Now, the market is already priced in the Fed not raising interest rates, and that all this year. They've priced that in already, that the Fed's not going to raise interest rates any this year. Well, we're going to have to wait and see what the Fed's going to do. My best guess is they are going to raise rates this year, at least once. And the market's not priced this in. Think about that for a minute, okay? Now, okay, this is what's going on, folks. They haven't stopped quantitative tightening. We could still get this crash, because unless the Fed relents, you know, I mean, this is what we're looking at. Let's look at pre-market data. And the market, again, is being buoyed. 60 points up on the pre-market, okay? And the market's going to open up in an hour or two. We're going to have to see what the real market's going to do, but the pre-market gives you a good idea, a good indicator. Let's narrow the charts in and take a look at this real quick. Okay, let me bring the chart in here so you can see the pre-market and what we're looking at here. We're looking at 26,086, up 55 points on the Dow, and so we're up 55 points in the pre-market. Now let's head over here and take a look at oil today and see what oil's doing. Expand the charts back out again. We're looking at oil prices today, and what we're looking at is the oil has been steadily increasing in price, very slowly. It's been very slow, but it goes all the way back to $43.93 back on December 24th of 2018 up till now, and now we're looking at a price of $56.30. That's a fair little increase in price from $43.93 to $56.30. You know, that's more than $10. It's up like a dozen bucks. You know, it's been slowly increasing. This is OPEC doing this. Now, the United States is talking about a deal called NOPEC, you know, where they're going to actually come down hard on OPEC, you know, and OPEC is actually in a war. OPEC is actually, you got China and you got Russia, and they're working together. Iran's in there with them, and North Korea. They're all in that side, you know, over there working together, and they're not for the dollar. Let's put it that way. Who's for the dollar is the Fed, you know, but the Fed is basically pushing on a string, you know. But it's going to have an effect at a certain point, and that effect might be a snap, bang, bing, bang. It's like the whole thing flies apart. It's almost like an engine. If you're over racing the thing, you know, these race engines and stuff, and you're revving it up past 7,000 RPMs, and all of a sudden, boom, bang, bing, the piston comes flying out through the side of the engine. Well, you know what? That engine's perfect until the piston flies out. And that's the way with our economy, you know. If they keep this pressure on, this quantitative tightening, you know, and they keep raising interest rates, the whole thing's going to snap all at once. Now, let's take a look at bonds and rates here. And what we're looking at is we're looking at falling yields, but it's so far they haven't fell that much. They fell 1 basis point so far on the long end of the yield curve. So we're looking at 2.744 on the U.S. 10-year and 3.112 on the U.S. 30-year. The short end of the curve, we've got rising yield just slightly. It's a half a basis point. It's at 2.44 on the 3-month, you know. So we got a little bit of an inversion in the yield curve between the 2-year and the 5-year. The 2-year is higher than the 5-year by 0.3 of a basis point. So we do have a little bit of an inversion there between the 2-year and the 5-year. And this shows that an aversion for long-term, taking out debt for long-term. And this shows lack of investor confidence in U.S. bonds, basically. And this is why you get this inversion, where the shorter yields, the shorter-term bonds have a higher yield than the longer-term bonds, because they're buying them up more. They're buying up the 2-year big time. Look at this, 2.55% on the 2-year. Listen, these bonds are, people see them as a safe haven asset. This is completely erroneous, you know. I found the program yesterday. Well, maybe I shouldn't talk about that right now because it's going to mess up my market report, and it'll extend my time too long into this market report if I talk about it. But maybe I'll mention it at the end. You guys can listen to it if you want to. Oh, so let's move on. 2.9660 on the U.S. dollar index. And U.S. dollar index is trending upwards today, as you can see, quite steeply. Okay, so now I'm going to talk about that. Now that we've completed the market report of all the stuff I'm going to talk about today on prices and stuff. Now I'm going to talk about what I'm going to talk about is the bonds are actually a very risky asset, and what I want to talk about is gold right now. I'm going to talk about gold for just a couple minutes. I mentioned that I don't believe that they have any gold in Fort Knox, and up until yesterday, I had reasons why, but I didn't really get into the details of Fort Knox and what's going on there, you know. And now I watched a show that was so thorough, so in-depth on the gold in Fort Knox. I watched a show last night on it, and this guy, he was very, very thorough in going over the real information of what's going on in Fort Knox. It was an eye-opener to me. After watching that show now, I believe that the only gold that's in Fort Knox, after watching that show, is very thorough, very in-depth. The audits people think that they made on Fort Knox were really only on a handful of bars, less than 1% of the actual gold that's supposed to be there. The audits, the actual audits, and these audits go way back. You know, they didn't really audit it. All they did was is they took a sample of just one of the containers inside there, and the gold that they were doing the samples on was gold that had come from the confiscation of gold when they brought in all those coins and stuff, and they melted them down into gold bars that have a copperish tinge to them, and they're not really qualified to be sold into the open market because they're not pure gold. They were melted from a whole bunch of coins that they took in from the American people. Other than that, all of this other gold, after watching this show, my personal belief is that it's all fictitious. They've sealed these vaults with these supposed seals where the seal can't be broken so that they don't have to do an audit as long as the seal's on there. You know, the seal, a supposed seal. Well, they had those seals on there for years on vaults that are probably full of tungsten bars plated with gold. What's probably mostly there is tungsten bars plated with a thin plating of gold that's in vaults that they can't open because those vaults are supposedly sealed and been sealed like forever, you know. And after watching that show last night, I think I should put that show up and put a link, you know. Maybe I'll put a link in the description of this video. After watching that show last night, I don't believe there's any gold there except for a few coins that they've melted down into bars from when they confiscated the gold, you know. And other than that, all of that gold that they say they have is probably just tungsten bars covered with a gold plating, a thin gold plating. And they won't let anybody in there to see it, and there's a reason why. They won't let anybody in there to see it. Now, that's my opinion only, but that's my opinion after watching that very comprehensive show I watched last night. I'm going to search it up and find it for you guys, and you guys can go and watch it too, because it's going to really help you with understanding what's really in Fort Knox, you know. Thank you guys for listening. Oh, and another thing he said on the show, he said that one of the reasons, if this is all true, that there really is no gold at Fort Knox, or very little gold at Fort Knox, they can't ever bring that out to the public. And the reason why is the effect it would have on gold prices and stuff. You know, they could never make that known, actually known. So thank you guys for listening. Like and subscribe, and we'll catch you guys on the next show. Bye-bye, guys.